Hey everybody, Rob Maurer here, and today's conversation is about Tesla short selling with Ihor Dusaniwsky, the Managing Director of Predictive Analytics at S3 Partners. S3 Partners is a financial technology company providing data and technology to Bloomberg, the Nasdaq, and over 400 institutional clients. Altogether, those clients manage more than $2 trillion in assets. Before we get into the conversation, two quick things. If you're not familiar with short selling is borrowing stock from somebody that owns that stock, selling the stock that you have borrowed into the market, and then hoping to buy that stock back later for a cheaper price. If you buy it back cheaper than you sold it for, you profit on the difference. Generally, that means if you're short selling a stock, you're hoping for it to go down, although short selling can be used as a hedge against other positions. Second quick thing, this conversation does represent our own personal points of view and should not be taken as any sort of financial advice. The other thing is, if you appreciate this content, it does take a lot of time and money to produce. You can show your appreciation for that by hitting subscribe. With that, we'll hop into the conversation with me asking Ihor to give us a bit of background on his position at S3.
Sure. I started out in stock loan, actually started on controllers years and years ago, some 30 years ago. And Morgan Stanley got into the stock loan desk. I've been doing stock loan for forever now. But the big thing is that I was on the buy side for the longest time, working with hedge funds, brokers, regular investors. Now I'm on the other side. Actually, I'm not even on the sell side, on the buy side or the sell side. We're agnostic. We're sitting in the middle. So we have no X in any of the markets. We don't own positions. We don't do analysis of the value of companies. We're literally pulling information from all over the street, aggregating it, normalizing it, making sense of it, and then we have an algo that we've created and that we've been fine-tuning for 7-8 years that predicts, that actually calculates short interest on a daily basis. So instead of getting stale data that's 2 weeks old, or depending on which country we're talking about, because we actually have data for over 40,000 stocks worldwide, we're able to give you today's numbers, and it's usable for our clients. And basically what we're trying to do for the clients is have them look at cash moves, stock price moves, and try to understand whether the shorts are responsible. Is it short selling? Is it short covering? Is it long buying? Is it long selling? So a lot of times we'll hear on the street, and it's one of my little pet peeves, is everything's a short squeeze. And
the same for me.
And it's a wonderful little catchphrase that people use, but it's not always true. And it could be partially true, but it's not. I get a kick out of I see short interest going down by 1,000 shares, and trading volume was 50 million shares. I'm like, oh, it's a short squeeze. So I go, I don't think those 1,000 shares
not quite
made the difference.
So that's a good segue into sort of why I wanted to speak with you, and I think probably why a lot of the listeners are going to be aware of you is because you do post updates on Tesla short interest. Right. Obviously, Tesla is now the most shorted company by dollar value.
Yeah, by far.
In the world.
By far.
So let's talk about just sort of what has played out with Tesla over the last, let's call it 6 to 9 months. Obviously, we've seen short interest go from 45 million shares back in June down to like a 22.5 now, something like that. So speaking to the short squeeze aspect of it, has this been a short squeeze to you? And I know there's different levels.
Yeah, and I've kind of had to go back in history and reevaluate things as well. Mm-hmm. There's a short squeeze and then there's a short squeeze. So it's what people usually look at a short squeeze is this dramatic exit of short sellers from the market, causing the price to spike because they're buying to cover. We haven't had that in Tesla. What we've had was a gradual decrease in shares shorted. A lot of it is because people have short positions that have risk limits on them. So if I have 100 shares, well, let's look at round numbers, 1,000 shares at $100 a share. So I have $100,000. That's my risk limit. If the stock price goes up to $200 a share, well, I've got to sell half my position just to stay at my risk limit. So that's not a short squeeze, that's people managing their book.
Right.
So if we look at a graph of shares shorted for Tesla, we'll see this decrease of shares. If I look at the value of the shares shorted at Tesla, it's kind of steady. So a lot of the shares shorted was basically book management rather than a short squeeze. So looking back, that's what I was kind of pointing to, saying, hey, this is investors managing their book. It's not really that they're getting pushed out of the trade, even though they're losing money hand over fist.
Right.
So there was a associative thing where they're losing money, but it wasn't the causative of the causation of the selling.
Right. Not akin to other short squeezes that people may be familiar with in terms of like, the most famous one in the automotive sector would be the VW squeeze.
Right, VW Porsche.
And to me, when I think about short squeeze, that's more what I think about, where literally there's no other option and you have to buy the shares back because you get basically margin called because of the infinite risk that you have on a short position. So that's more what I view a short squeeze as, that kind of like what you sort of think of it as too.
Exactly. So we'll see short squeezes in sections of, let's say, in smaller time periods across the last 6 months with Tesla, where I'll look and I go, all right, this was a squeeze. This is the price really appreciated, and I see some shorts capitulating. But then I'll see some movement where I'm like, okay, this is more book management, and again, oh, here's another piece of short squeeze. So I kind of coined the phrase, it's a short hug. It's guys who are getting pushed out, but it wasn't this massive exit.
Not like forced out across a lot of different.
Exactly. And then you've got the secondary buffer of so many hedges on Tesla as well.
Right.
So you've got the convertible hedges.
I don't think a lot of people talk about, but a short position can be a hedge for these other positions that you're mentioning here.
Exactly. So you've got several Tesla converts. There is something called convertible arbitrage, which means a convertible bond holder will sometimes buy the bond, and it has a conversion to the underlying security. So I can buy Tesla convertible bonds, and at a certain strike price, conversion price, I can exchange that bond for Tesla shares. All well and good, but now I've got a bond that pays me interest, but I also have Tesla stock risk associated with it. So convertible bond traders will say, oh, you know what, I want to get rid of this Tesla exposure, but I like the bond. I want the bond payments.
Right.
So they'll short stock and go long the convertible bond. Now that short stock piece varies as to how close you are to that conversion price. So conversion price for their bonds is between 3 and 357, I think. I can't remember
somewhere
exactly.
In that range, yeah.
So when Tesla's trading at $170, well, I don't have to hedge all of this bond because it's unlikely at the time. It was unlikely that Tesla was going to hit $300, or at least the probabilities were not as high.
Yep.
So instead of hedging 100 shares of every 100 shares of convertible stock, I would hedge 20. Now, as the Tesla stock price got closer to the conversion price, you had to hedge more. It's called delta hedging.
Can you explain just a little bit about how that hedge actually offsets the risk with the bond?
Sure. So what happens is the bond has a let's call it even numbers. It has 100 shares of conversion. So I have 100 share risk of Tesla because at one point this bond is going to be valued as the price of the stock. So it stops being a bond, it turns into a stock.
When the conversion takes place, if the
price is, so if the conversion is 300, the price is 400, really you don't have a bond anymore. You really have 100 shares of Tesla stock because you can buy it at 300 and immediately sell it at 400. So it's being priced as if it's a share of Tesla stock.
Right.
So as the price goes up, you want to short or you want to hedge more of that bond. So as the bond price...
because when the price falls back down, then you're losing the upside that you have, so you kind of lock it in with the short?
So then you'll be buying to cover your short.
Right.
So you'll be reducing your hedge because now there's less probability. And this is all done by black boxes that say, they'll run a Monte Carlo simulation or they use some sort of predictive analytics, and they'll say they'll look at past volatility, past price moves, future what the market's doing at the time, and they'll say, hey, I got for every one bond I've got to short 27 shares of Tesla. They'll go a week later, they'll go, I got to short 35 shares of Tesla. So there's always more and more as it gets closer. Now that the stock price is 900, you're shorting basically 100% of your Tesla exposure in these bonds, which ends up being somewhere between 9 and 11 million shares, give or take.
So your feeling is that about half the short interest right now, a little bit less maybe, is delta hedging, essentially.
Delta hedging to the convertible.
Okay.
Right.
So that's interesting then, because if I'm understanding correctly, when we go back and the stock would have been at 177, there's less need to have that short position to cover as a delta hedge, which means that the true short interest, non-delta hedged short interest would have been even higher when we had a lower stock price.
Exactly.
So maybe the true short interest back at that point was maybe like 40 million shares, and maybe now could be down to somewhere around like 10 million, something like that?
10 to 14 million, I would say right now. And again, a lot of this hedging is subjective to the firm that's doing the hedging,
right.
the black
Everyone
box
has
they're
different
using.
algos and rules
And
stuff.
they're also hedging with options, they're hedging with swaps, they're hedging with other different securities sometimes, because they'll find that they want to have a better performance on the hedge side versus the bond side. So it can get pretty complicated on what they're hedging with.
For sure. And that goes back to the start. That's kind of what you guys are sort of helping aggregate, sort of all that different stuff.
Yeah, and we attempted to, at one point, to kind of calculate all the hedges of all the stocks in the world for convert bonds, but we ended up, it was getting too complicated, and there were too many issues that we were running into. So I said, you know what, let's make this simple and just say, here's what we're seeing on the short side period. And it's up to the person who's using our research to kind of understand, there's some sort of hedge out there.
Got it. Okay. That makes sense. So on your daily short interest update, I think a lot of people are interested in hearing a little bit more about that, and obviously that some of that's proprietary, but I would love if you could give us just a little bit more insight into how you guys are getting to the numbers that you have. And then naturally I'm a skeptical person, so forgive me for coming in with a little bit of skepticism around those numbers. I have noticed that at times the numbers that you report don't necessarily tie up to like the NASDAQ official numbers when those end up getting released for those certain days. So if you could speak to that a little bit too.
Sure, absolutely. We take a lot of data from a lot of different sources. So number one is, we have our layered technology, which is our portals and such. So we get to see a lot of positions from our clients. We have over 2 trillion of assets under advisement. So we're seeing a lot of positions internally. So that's one piece of our puzzle. Another one is that we're also looking at all the exchanges. So for the U.S., it's NASDAQ and New York Stock Exchange numbers. We're also looking at data that we're getting from the street. So there are counterparties that we deal with on the street. So we're getting some of their data of what the activity of Tesla is there. We have a stock loan trading desk, a service desk that actually pings the street daily for color and activity on the more important names or the more volatile names. So myself and 5 other guys here in our firm are sitting here and we're talking to the street. So we're trying to figure out what's going on for our clients and for the production of our numbers. And lastly, we also subscribe to data sources around the street as well. So we take all this, we have our algorithm, sits on top of it, churns it out, spits out a number, creates a number for us on a daily basis for short interest. And on a directional basis, we are pretty much on point all the time. But because there's a lot of undisclosed activity on the short side, where you've got short selling at a broker that's using their internal supply to cover that short, no one sees that.
Okay.
So that's the variable that's always in the mix of how close our number is. So our numbers have been within 30,000 shares to you being a million or so shares off, depending on how much internal activity is going on in the stock.
Okay.
So we, on a predictive basis, I think our back testing says that we're 85 to 90% of the time we're within 10% of the number.
Okay, got it.
So we have.
And has that been improving over time as you guys kind of?
And it's all name specific.
Adjust? Okay.
It's all name specific. So some names you really have a really high hit ratio. Other names so much. Tesla's usually pretty good. Basically, we're on Bloomberg or on Reuters. Bloomberg gave us a thorough look through our numbers, our process and such before they even put us on their platform. We have a bunch of quants that use our numbers, so they've incorporated into their black boxes, as well as a bunch of long short hedge funds. We have a ton of hedge funds on our platform. So it's been thoroughly vetted that the number is good. And again, you have your weeks where it's closer, it's not closer.
Something different happens.
But there are things going on in the market that are just impossible to see and predict.
For sure. Okay, that makes sense. One of the points that you mentioned was just looking at sort of like the NASDAQ and the New York Stock Exchange in general. What did you mean by that in terms of like how that
Well, we look at the numbers that are reported on 2-week numbers that are reported on the delay, official numbers, and we look through that and we say, okay, how do we tweak our algorithm to reflect what's going on in the stock? And the thing is that even on certain stocks, we might have, or the algorithm works perfectly fine until something changes in that particular stock. So we might have to tweak that algorithm for that individual stock sometimes to say, yeah, this has worked forever, but wow, things have changed. So the vol, the gamma's changed in the stock. The price movements really started acting wacky. So the underlying investors are trading differently. So we start tweaking, and so there's always room for improvement, and we try to improve on an ongoing basis.
For sure, that makes sense. Are you seeing any of that with Tesla right now? Obviously, things have changed a bit.
Yeah, and this is going to be interesting because the trading above $900 is going to make the shorts act totally differently. Mm-hmm. So we're kind of sitting here and waiting to see what happens. We are, again, not seeing, and one of the things that's interesting with Tesla, a lot of the price moves are right at the open. And so it's not like you'll see, most stocks have, a stock will open at $15 and it'll 16, 17, it'll run up to 19 throughout the day. Tesla opens up 40. So these shorts are
especially lately.
Yeah, these shorts are getting bloodied right off the bat.
Right.
So there's less of a chance for these guys to cover because they've already taken the hit. So like, well, okay, I can't do anything about it. I've already taken a $40 hit to my P&L. So let's sit and wait and see what happens. So whereas other stocks that have gradual moves in their price, you'll see short sellers as well as long sellers trade intraday to say, well, I like this, I don't like this, let me get in, let me get out, let me adjust my position intraday. A lot of times with Tesla, you don't have that chance.
Right. So that brings me to one of my next questions is sort of the intraday. So you guys, have your daily process. How much are you focused on even sort of a shorter period of time, like intraday, and specifically when we see these, huge spikes or drops during trading for Tesla like we did, mm-hmm. I think a week back or so, it shot up from 900 to like 969, kind of peaked at that all-time high.
Right.
And then it fell to like 880 in 10 minutes. I'd love to hear just a little bit more about your perspective on some of those dramatic moves and the intraday process.
And that's what our trading desk is here for, our service desk. We end up pinging the street, and we talk to brokers, other market participants, hedge funds, some large institutional long-only guys, and we try to see what's going on. Sometimes we get good answers, sometimes you don't get good answers. Most of the investors and institutional guys are very quiet about what they're doing.
Justifiably so, yeah.
And but we do get color, so we'll see. And sometimes it's especially on moves like that, it's really hard to get color because a lot of people, really don't know what happened at that moment. It's kind of after the fact. They'll go, oh, yeah, that's what happened.
Okay.
But at the moment, it isn't. What we'll see a lot of times is whether there's increased demand for short selling intraday, because we'll actually ask around and see from the brokers what they're seeing from their clients. People have to get locates, people have to get color, and we'll just have an idea of, hey, this is what's happening in this name. It's really a bilateral market where it's stock loan and short selling is you trading with me. I'm borrowing stock from you, so no one else knows. So, and it's not projected out to the street and in daily trading volumes and such. So as long as I don't talk and you don't talk, no one knows this occurred.
Yeah.
So we're trying to find.
Yeah.
That
and I think a lot of retail traders, I think a lot of people have learned a lot about this because of Tesla, and I think a lot of people are curious as to why it's not a little bit more regulated and why there's not a little bit more transparency with short selling, because I really feel like there's not a reason that there shouldn't be. Because short selling is supposed to exist to help,
provide
liquidity and to allow for a way to incentivize good behavior, I guess, in the stock market, where there is that ability to, profit if there's fraud or something like that happening and you sort of catch it. So I don't see why there's not a little bit more transparency. And maybe this isn't a question for you, it's just kind of coming to mind right now.
Actually, it is, because this is why we're here.
Okay, yeah. So what are your thoughts on sort of that?
Yeah, one of our main tenets in our company is that we're providing transparency in an opaque market. It's really important to us, and it's really important to our clients to be able to see what's going on, because no one else is allowing them to see this.
Right.
When you're talking to certain market participants, the data or the commentary is always a little bit jaded, or it's got an angle to it. We sit here and we don't have an axe to grind, and upside, downside. I'm not allowed to buy stocks. I'm not allowed to hold stocks. So I can't profit from anything, and none of us here can. We're just looking to provide color. So one of the reasons Bob Sloan, our managing partner, founded this firm was to provide. He realized that this is such an opaque market where that the idea of providing transparency would be a big hit. It'd be a winner, and he was right. We're providing transparency to long owners. So if I'm long the stock, I really want to know what the shorts are doing, whether I can lend my stock, whether the shorts are coming in, coming out. The problem is that stock loan is not your normal market where you can go through a DTC and or an exchange and buy and sell via the exchange. There's no centralized area where all the trades are going through. It's all one-on-one because it's a contract between one and one. So in stock loan, you have, let's say, the beneficial owner gives it to a lender. The lender has this big portfolio, and they try to push it out to the street. Now,
so that would be like a brokerage, like Fidelity, for example?
Right. State Street, Fidelity, any of the long-only guys, any of the retail shops, your E-Trades, your Schwabs and stuff, Morgan Stanley, everyone who's long either institutional or retail stocks. So they'll be long the stock, and someone like a State Street is mandated, hey, I'm giving you a portfolio, it's a pension fund, it's giving you a $10 billion portfolio, lend my stock, make some money because I want incremental revenues from my portfolio. They go out and try to lend the stock. Now, if I am a broker, I go to State Street and say, hey, do you have, or one of these custody banks, I said, do you have any Tesla? And they'll say, yes, I do. Great, I want to borrow it, and they'll give a rate. The rate is all supply-demand driven. So if there's a lot of supply, the rate is what we call general collateral, which is GC, which is around 30 basis points, depending on contractually what your rates are with your broker.
And that's like an APR?
Yeah, for the year. Yeah, okay. It's an annualized rate.
So very low cost.
Very low cost for Tesla, for IBM, for Walmart, for any of these names that you would think, the big S&P 500 names, Amazon and such. It's 30 basis points. It's GC. It's everyone's got it. Everyone wants to get rid of it. So let me make some incremental money by getting a 30 basis point borrow fee. Mm-hmm. But it's a deal that I'm having with you. Why is it a deal with you? Well, you have an underlying client that's long the stock. If that underlying client sells his stock, he needs his back to deliver it.
Right. Which
means you have to go out and say, who did I lend the stock to? Oh, I lent it out to you. You call me up and say, hey, I need that stock back. So there's this tail that's attached to every trade where I need it back. Whereas with buying and selling stocks, there is no chain attached to that share of stock. Once you buy it, it's yours. There's no one else involved in this. The trade has happened and it's finished. With stock loan, it's not. With stock loan, there's always this thing where or if the stock price goes up, well, I lent you stock, so you lent me Tesla at $300 a share. So stock price goes up to $900. Well, I put up $300, and so it's collateral is 102%. So I put up $306 of collateral with you. Just in case I go bankrupt and you can't get your shares back from me, you can actually go out to the market and buy the shares to cover your client. So when I've put up this collateral and the stock goes up to 900, you knock on my door and say, you owe me more collateral. So now I owe you $918 of collateral. So every day there's this collateral account where either I owe you or you owe me collateral, depending on what the stock price is.
Increase or reduce.
And that's, again, where that chain is. It's like I'm borrowing from you, so you have to protect your underlying long owner that's lending it, so you've got to keep coming back and forth with me for collateral. So, and there's kind of why this is not such a transparent market, because all these trades are done on a contractual basis, one-on-one. That's very hard to have sitting in this big depository where all this information is going to be sitting around, because if you're just lending to a centralized system, well, who are you recalling? Who are you getting collateral from? You have these risks that are hard to pass over to a unknown end user.
So there's the tail there, but is that tail sort of transferable in terms of like me as an individual, if Fidelity goes and loans my shares out to short seller A?
Right.
Can they just work from their pool of shares to give me back 100 shares? Like
they can. So
it's just Fidelity is sort of like they're the tail then, and then I'm just sort of like a piece of that.
And that's what happens with most of these custody banks and brokers, is that they're lending shares out. So if they lend out 1,000 shares of Tesla, there might be 40, 50, 60, 100 different underlying long shareholders where I borrowed 2 from you, 6 from you, 4 from you, 5 from you, and so on and so on. So it's not just one guy. I'm not borrowing just one guy's shares. They have a fiduciary responsibility, a lot of them, to split it out amongst all their underlying long shareholders.
Right. To reduce spread the risk evenly.
And not even just spread the risk, but more just that if you're in Fidelity, and why is someone getting treated better than me? If you're in the lending program, well, why are you lending out 200 shares of his stock and none of mine?
Yeah.
So they have to they have an algorithm that kind of splits it all out so everyone's treated fairly.
Sure. So I get the question a lot amongst Tesla retail investors. Do brokerages can they just lend shares without permission? Like, a lot of people are concerned about that and don't want their shares to be lent. Do you have any advice or thoughts on that idea?
Actually, there's a great follow-up point on this, which I'll do. You can only borrow. So a broker can only take shares if a person is in a margin account and using margin.
Okay. Actively has a margin position.
Right.
Either through additional stock bought on margin or through options, I'm guessing, that are utilizing the margin balance to cover the option.
Exactly.
Okay.
And only the amount of the margin. So if you have a $50,000 in your account and using $1,000 worth of margin, he can't just take your whole account. They can only take $1,000.
$1,000 worth of shares to lend out.
Right. Out.
And they're taking then the 0.3%, 30 basis points?
Yes, they're taking that extra. And what they do is they'll take in the 30 basis points, and that's how the brokers make money.
Okay.
Now, you can also have a contract or a deal with a broker to say, hey, lend my longs if you have something attractive. Tesla, not the most attractive stock in the world.
It used to be at one point. It used to be hard to borrow.
It used to be hard to borrow. You used to get 5% or more at one point a couple of years ago. But so now if you own Peloton, I would call my broker and say, can you lend my Peloton? Especially if it's fully paid for.
Even if you're not doing a margin specifically.
So I'm fully paid for Peloton, and they're like, you know what? I would really like to make 70% return on my Peloton stock by lending it out. Why shouldn't you?
Right.
Because there's a big kind of fear that, oh my God, I'm lending a short my stock, so it's hurting my stock price. It's such a small amount of activity that those extra few thousand shares is not going to make a dent in the stock price. You might as well make this extra incremental income.
Right.
I always advise everyone I know that if you're long a hot stock, lend it out, make some extra money. It's so much nicer to offset losses or to get some incremental income. And then you have the question I get on Twitter all the time is, well, what if I put in a sell order way above the stock price?
Then they get to cancel.
Then they can't lend my stock. Well, margin calculations are done on a settlement date basis, not on a trade date basis. Your order is a trade date order. So the cage, using an old term, operations back office, doesn't see that trade or that offer to sell at $15,000 a share. What they see is that you're long 1,000 shares of Tesla, and they need collateral, and they're going to grab it. So that order is not going to stop a prime broker or a broker from taking your shares if you're in margin account. If they have the ability, they're able to take that share. That's not going to prevent.
Okay. So the only way to avoid it is just have fully paid for your whole account, or is that fully paid for
your whole account?
Whole account.
Whole account. There is a way, and retail institutional is a little bit different because the size of the positions. On the institutional side, you can designate a certain stock being fully paid for and have them segregate it. On a retail side,
sort of like partitioning your account.
Exactly. So you'll have certain sections that are saying, hey, these are my fully paid and these are not. It's not really doable in retail.
Right.
So there is an algorithm that every broker has, which picks out all the best stocks for margin. So if you have 20 names in your portfolio and you owe $2,000 worth of margin, they'll go and say, don't need it. Oh, this one's good. Oh, you've got some Smile Direct Club. Great, I'll take that. And so they're not going to take IBM if they have a chance to get something that has more worth.
Right, because then they're getting a higher
getting a higher percent from the street.
Yeah, and then they, to your point earlier, if you make the agreement with them, they'll split sort of the commission that they're making off of that.
Right.
But otherwise,
the revenues.
unless you reach out, they're not going to do that.
And now it's really good. For the longest time, brokers were not willing to split revenues. And basically, if you call them and said, "Hey, I am long, I am long a real, GameStop, I am long AMC movies, I'm all these stocks that have good value," they'd say, "Sorry, no," because they weren't. For one thing, they probably didn't have the infrastructure to do it, and to pass along those revenues to the underlying clients, because it is a lot of infrastructure, a lot of IT, a lot of systems work. Now everyone's got it, so you can go to every single one of your brokers and say, call up their 1-800 number and say, "Hey, I want to participate in my lending long." The problem is you have to know which stocks are lendable. And that's kind of where our product comes in, where your retail guy can look in and say, "Oh, here are my 40 stocks in my portfolio. Well, these 3 are lendable. Let me go to my broker." The broker says, "Yeah, I'll borrow from you at 5%. And he said, "Well, I saw on S3's platform that it's a 15% stock. I think you're undercutting me." "Oh, yeah, I must have read that wrong. I'll give you
Right.
the 80% of the 15."
Okay.
So they'll give you a portion of what's being lent out. It's 70%, 60%. It all depends broker to broker and stock
Individual
to stock.
to individual, I'm sure, too.
Exactly.
Okay.
Exactly. But it's a nice way, and I really don't know how much more I can talk to people about this. But lending your stock almost never affects the stock price.
I think the theory with Tesla, there's a lot of, among the longs, there's a lot of animosity towards the shorts because people feel like the shorts have been manipulating the stock and spread misinformation on the company. So I think they just don't want, from sort of a philosophical point of view, to allow them to have any more access than they already do.
And you know what? And I fully get that, and I totally agree with you. There's a difference between the actual short sale and the
everything else, that
the information
incentives that come along,
and the information or the noise that comes from the long and short side. It's the misinformation, let's call it like that. That's different. That affects the stock price
for sure.
That extra short, and a lot of times it's really just if you're not going to lend your shares out. Again, Tesla's probably not the at the moment it's not a great example because it is a cheap stock to borrow. But if you're not going to lend a stock out, someone else is. So you're not stopping the short.
Right.
It's going to happen.
All the shares are still going to be lent. It's just you might affect the interest rate slightly if you.
Or
you wouldn't. Assuming you had like half the shares or something.
Right. Exactly. That's what I mean. It's So you might as well stick it to the shorts even more by saying, "Now I'm making money off of you.
Pay me, and then I'll buy more stock long."
Yes, there you go. Mm-hmm. And or say you want to short it, go ahead. Not only are you going to lose money, but I'm going to make money off this trade.
Yeah.
So double good on me.
Yeah, that makes sense.
Yeah.
I want to shift back, and I think we're getting close on time here, but I want to shift back just for a second to sort of that intraday sort of trading and stuff, and feel free to just completely skip over this question. But on the topic of sort of like shorts and the influence on the stock, a lot of people feel like there's manipulation that can occur intraday on Tesla specifically, and probably other stocks too, but I follow Tesla the most closely. Where, let's go back to the example we talked about earlier, I think, last Thursday, Friday, where stock was, slowly edging up all day, and then it hits 970, and all of a sudden there's just all this selling.
Right.
Do you think, and again, feel free to pass, but do you think that in times like that, the theory exists that shorts will then sell a lot of shares into the market to cap that rally, because then that limits their loss on the rest of their position, to what you were talking about earlier with the collateralization and things like that, and having to stay under a certain threshold? And if you sell a lot into the market at a certain point in time, that's going to cause, the stock to drop. A long wouldn't have much incentive to do that, because they're going to try to exit their position more slowly so as to not cause that impact, because they want to maximize the value they can get out of removing that position. So when I see stuff like that, I definitely.
But a long holder that's already long might want to do that in order to make the value of the rest of his long stocks higher.
What do you mean?
So if someone's long 50,000 shares and starts buying into it in order to increase the price of those 50,000 shares, so it's kind of works on both sides.
For sure, it could work on the way up too.
Yeah.
I guess in this instance, I'm specifically asking sort of about what may have happened at that point in time, and just get your kind of thoughts on it, because to me it looked like that seems like the most likely thing for that. And then what happens is when you sell those shares in the market, then you hit the stop losses and then like, waterfall them down.
Right.
So it seems like there's a lot of incentive for a short seller to do that. Obviously, it's risky. If that doesn't work, then like you just shorted a bunch into the market and now you have to buy it back at a higher price. But I would be curious just to hear your thoughts on that, because it is something that Tesla retail investors specifically talk about a lot, and there's a lot of speculation out there.
I mean, the one thing that I do see a lot is a lot more conspiracy theories with Tesla than and more ideas of short sellers working in tandem. Most institutional short sellers, people in size that have enough money to actually move the market, will not give each other their emails or telephone numbers, much less sit there and try to coordinate a buying or trading strategy together. That being said, if you see these moves, a lot of times there's a lot of moves that are triggers. So when you see momentum guys, you see quants, and this is a lot of things that people think are coordinated efforts are really black boxes working, because think about it, there's a lot of black boxes out there working these algorithms, working these trading strategies, where most of the people that created these black boxes came out of the same family of
same school of thought, basically.
Hedge funds or long-only guys or whatever. So their formulas are not so different from each other. So when certain things happen, and I see that a lot when looking at the market, I'll see this action and I'll go, wow, the quants just something just triggered some of these quants, because it'd be like bang, 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 all of a sudden this activity comes one after the other, and it looks like there's this flood. Well, it's because everyone says, well, if the market, as the stock price goes up, if it goes down, 5%, then trigger all these sell orders. Well, everyone's been brought up saying 5% down, trigger the sell orders. So there's 100 black boxes sitting there waiting, to
for
do this.
Different threshold that are often similar.
Often very, very similar. So you'll see it, and again, especially market on close, there's a lot of activity that's done in market on close that's more technical in nature than value or human driven.
When you say market on close, is that just like heading into the close of the day, or what do you mean by that?
Well, you have two different. Good point. There's nearing the close is you start seeing some of these guys starting to put in orders to kind of fix their books by the end of the day, so they don't stay long or short overnight more than they want to be.
Okay.
So right around that 3:30
we're talking about, it was I think like 12 minutes before close.
Yeah. So around 3:30, people will start placing these orders. Say, I'm a little bit longer than I want to be. I've got a half hour to basically sell off 50,000 shares, or I want to be shorter overnight, or so I didn't have a chance. So I've been working my VWAP all day long. I've been putting in my orders. I wanted to go short 75,000 shares. I only got 45,000 off. I got to get 30,000 shares in this last half hour. Let me finish my trading. And then you have these market on close orders. Again, the last 15 minutes, it gets a little more. So you get these stacks of orders that are sitting there that need to be executed before the market closes at 4 o'clock. So you'll get a lot of really, in some names, at some days, you'll see this huge amount of activity, and sometimes you'll see after the market closes, you see the prices just keep tumbling or going up, and you're like, well, the market's closed. Why is the price moving? Well, there were so many orders that were being processed, it didn't even have a chance to hit the tape. It got put in, but it still hasn't been even processed. So you'll see for 2-3 minutes sometimes the price is going up or down because those market on close or those late orders are getting filled and reported. For this Tesla move, I think that's what happened. Is you had just a bucket load of orders that were sitting there waiting to get filled. And the thing is, once the price started going down, then not only did you catch this guy's sale, you caught this guy's sale, you got caught this, and think of it, a lot of momentum day traders also out there. So the price went up to 960.
Especially with Tesla like right now, right?
960. If I got the run to 960, there is no way I'm going home and not putting in a sell at 925 or 940 or whatever it is. I'm saying I'm realizing my profits. Right. I'm not going to leave this on the table.
Right.
Because I can get in later on. But I'm thinking, hey, you know what? There's probably going to be a pullback because there's such a big move. I'm just going to put in my limit orders and stack them so I get filled. Maybe 5% of my position goes at this price, another 5, another 5, another 5. Well, market on close, it went from, you had such a huge move, and this just snapped up all these limit orders.
Right.
So what looked like a concerted one-shot effort of sales was a whole slew of limit orders that got kicked off from these high prices to low prices right at the close.
Right. And I guess that's sort of the essence of the thesis is like people know that that's going to happen. So there's a lot of incentive to dump a bunch of shares in the market to try to like trigger that, to your point.
Or
earlier.
not even trigger it, but I think everyone's going to put a market on close at 9:45. I'm going to get out at 9:45.50. Because at 9:45, I might not have enough buyers to take my stock.
It might drop another $5 or something.
Before I get a buyer that fills my order.
Right.
So you know what? If I see this big mass, or I think there's this big mass of sellers, limit order sellers at 9:45, well, I don't want to be in that group. I'd rather be 25, 50 cents above that and get filled, as opposed to get stuck in this big crowd where I've got, it's kind of like these guys getting out of a concert. You got 50,000 people getting out of 3 doors.
Yeah.
It's no one's getting filled. A few people are getting filled at a time.
Right.
And so this is what happens when you have, especially with Tesla, because you got this volatility and you got so much trading volume. And then I think that a lot of times you don't have the other side of the trade. So what we see a lot is bids versus offers are really mismatched. And this is back in the day when there were market makers on the floor. They would handle this a little more creatively and try to do the matches and try to move the price where you don't get these huge runs and these avalanches.
Right.
But with everything being computer driven and automatically executed, you see these bang, 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 and all of a sudden you close your eyes and you're like, down 40? What happened here?
In 6 minutes.
Yeah, it was absurd. I mean, I sat there and watched, and I was like, oh my God, I'm so glad I don't own stock at all, because
I sat there and watched it too. Just Tesla.
Yeah, and people are getting carried out on the upside, downside, and if you're, I think this is one of the stocks where you love the stock, you want to be a long-term holder. That's great. If you're playing intraday, wow, you're
up against a lot.
You got a pair of brass balls, because it's you really have to look and watch and be careful and be so diligent in your trading strategies, because otherwise you can get carried out.
Right, deck is stacked against you.
Yeah, but you can make a fortune too.
Yeah. All right, I think that's a great spot to leave it.
Great.
Really appreciate the conversation. Thanks for coming on, Ihor.
Oh, my pleasure. It was very nice. I like the fact that I've gotten involved in the Tesla world, and
it's a fun world to be in. All right,
Thank you.
appreciate it.